This segment focuses on common mistakes investors make and how to avoid them, ensuring a strategic approach to this diverse investment landscape. One major misstep is investing based on a brand rather than solid data. It's easy to be swayed by well-known names, but thorough research and understanding of the investment are crucial. Another pitfall is chasing the latest trends without considering their alignment with your overall portfolio. It's essential to resist the allure of hot asset classes and focus on how they fit into your investment strategy. Underestimating the unique risks of alternative investments, such as liquidity concerns and market volatility, is another common error. These investments, including real estate, private equity, and digital assets, require a deep understanding of their risk-return profiles. Additionally, investors often overlook the higher fees and expenses associated with these assets, impacting overall returns. To navigate these pitfalls, conduct comprehensive research, understand each investment's risk profile, and ensure a diversified portfolio. Since David mentioned high fees, mediocre performance when it comes to a lot of hedge funds, and certainly last year was a period where it didn't pay. It was very difficult to manage risk. When you have a magnificent 7 just driving performance, you didn't need to manage risk. Just own the S&P, and it was very difficult to beat the S&P. David, what are the common pitfalls when an investor is considering alternative investments? Like, what should they look at? I mean, it sounds like performance net of fees, but then don't chase performance.
Well, I think I wrote a book a couple years ago called 10 Questions to Master Successful Investing. And one of the questions is understand, what's the upside? What is it that drives the return? We talked earlier about the return of something like art or gold. It's because there's no cash flow. It's demand from people wanting to hold it, or institutions. And we've talked about why that's the case. The beauty of stocks or real estate is, particularly stocks, is you get cash flow. I mean, that's the driver. It's that dividend. And is the cash flow growing over time in terms of the earnings growth? And then almost more importantly is how much are investors paying for the cash flow, and in terms of PE or in terms of the cap rate for real estate. And so for any asset class, as we research, we need to understand what are the downside, but what is underlying the return, so I know what's a reasonable expected return, and then understand who's on the other side of the trade, like who's selling me this asset. And that's why investors have moved to index funds, because the good companies and the bad companies cancel each other out, and it's driven by the cash flow growth. And then the key is to make sure we're diversified and not completely focused on US, but have investments outside of the US. Because I mean, there's very few people like Gary that can run 5 holdings successfully. Most of us can't do that. We don't have that type of knowledge. And so as individual investors, we want to broaden out what is it that drives a return, and then add a little bit of spice in some of the things that we talked about today. But mostly we should be income focused, cash flow focused, and how that cash flow grows over time. So we're compounding our returns year in and year out.
Ric, you're the futurist among us. What do you see in the future, and how can that inform how we're positioning in alternative investments?
Well, I think that the word for the 21st century is technology. It is innovation, and the innovation is coming at a faster pace than it ever has before. We're seeing the very early stages of the results of this through blockchain that was invented in 2009, AI, which is now generating huge levels of attention through open AI and ChatGPT and the whole aspect of generative AI. We're going to see major leaps and bounds in innovation over the next several decades. And it's already beginning in virtually every aspect of society, of industry, around the world. You need to make sure that your portfolio is constructed for the 21st century. If you are investing in companies, if you have an asset allocation that is modeled on the 20th century, you're going to fail. Even where that would have been successful in the 20th century, it won't succeed in the 21st century. You need to make sure that your investment strategy, your portfolio is designed to fit the world we are living in and the one that we're going to be living in.
And how about you, Gary? What are your thoughts?
First of all, those are both phenomenal answers. Ric's answer that he just gave is a terrific one, and I actually want to come back to that in a second. David was saying a big question is who's on the other side of the trade. And it's a great question to ask, because the question I always ask is, what's the flaw in the narrative, right? What am I missing? What is everyone else missing? And if you don't have an answer to that, it's like the old saw about if you don't know who the sucker is at the poker table, it's you. I think there are two key mistakes that people make, two flaws that are worth pointing out. One of them touches on Ric's point, which is you really do need a 21st century model. And the 20th century model placed too much emphasis on short-term volatility, right? And that came out of the guys at long-term capital management, and who blew up so spectacularly. I think they said, if it was an event that shouldn't have happened if the universe were 14 times as old as it was, right? We need 14 lifetimes of the universe for this event to happen. And it happened within the first 2 or 3 years. And that should have put an end to the way they viewed things. And I think the reason it didn't is because it was measurable and people like what they can measure. But the truth is, if you're a long-term investor, the short-term volatility really isn't that meaningful, and everybody's focused on it. They say it's the proper measure of risk. It's not. It's permanent loss of capital, particularly if you have the time frame to wait it out. That gives you an enormous advantage, being able to pick your entry and exit points. The second point I'd make is there's too much following. Don't follow everybody else. And, we were just talking a few minutes ago about, how hard it is to be an asset allocator. But a lot of the asset allocators I saw, they would do a lot of work and do a lot of research and maintain these enormous databases. And then what they would do is they would take that work, throw it out, and do what everybody else is doing, because the name of the game is don't be wrong alone. But doing what everybody else is doing doesn't get you good returns. And, listen, all three of us were negative on the performance of the hedge fund business. And I, as somebody who is in that business, I readily acknowledge, the industry didn't shift as quickly as it should have. And as an industry, we have not had a great last, 10, 15 years. But it's easy to blame the hedge funds. One of the things that is worth pointing out is a lot of the asset allocators reward the asset gatherers, right? Instead of looking for great performers with a great process, they'll find those guys and then say, but you're too small. I don't want to invest with you. And they'll invest with everybody else. And so it incentivizes a limited number of managers to continue gathering assets and turn out mediocre performance, because as long as you're big and don't blow up, you're going to make a lot of money. And so I think there are bad incentives and bad behavior on all sides. If you're listening to this and you're making your own investment decisions, figure it out, instead of following everybody else into the same assets or the same managers, find the people who have a good process and who are thoughtful.
Well, I want to thank our panelists for joining me for this episode and really giving us a lot to think about. There are a diverse range of assets that make up alternatives. It can be real estate, it can be art, it can be cryptocurrencies, it can be NFTs, which we didn't even really talk about, hedge funds, private equity. And I think the takeaway is just, it's worth taking a look to do your research, to invest in things that you can understand, and then allocate a small portion of your portfolio to that, because it can give you some protection against volatility. It can give you long-term potential growth. And just look at the world, I think, as an investor. Look at the tangible investments. Look at digital investments. Look at your stocks and bonds, and really be an investor. And I love the idea of, it has to be forward-looking and not backward-looking. You need to own a 21st century portfolio in the 21st century. So thank you to our panelists once again. You can find Ric Edelman at the truthaboutyf.com. Is that where you want to send people, Ric?
If that works, The Truth About Your Future, that's my daily podcast, or easier, dacfp.com, dacfp.com.
Thank you. David Stein, you can find at moneyfortherestofus.com. Fantastic podcast and website. And Gary Brode, deepknowledgeinvesting.com. Thank you, everybody, for joining us for this episode. And I hope to see you next week, Wednesday, January 31st at 6 p.m. Episode 21. We're talking about the art of negotiation, mastering the skill of financial success. It's something that I think can bring tremendous value to your life, but it's something that many of us don't really enjoy as Americans. So we're going to talk about negotiation and hopefully pick up some skills that we can apply to our daily lives. Thanks for joining me, and I hope to see you next week. In the meantime, do something that scares you, because that's where the magic happens.